Look, I asked what people wanted to have me react to, and this is a video that I got. And I've met this guy a couple times. I've never done a reaction video, but it's time. It's time. So, Doug Andrew, here we go, man. This is like,
here we go.
You did the video. I know that you have a video that shows up pretty early.
Yeah, I've done a video on Doug and his philosophy and Laser Fund. I've done a lot of reviews on his book.
Misfortune was the early
It was a Laser
book,
Fund is the one that I did the review on. But listen, it's no secret I don't agree with really anything he says. I think we chose this video to react to simply because we watched the first 3 minutes of it and we're like, it's not even accurate what he's saying.
So he's talking about universal life, index universal life versus whole life, and why index universal life is going to beat whole life.
Yep.
And again, he's going to be making cash value arguments, not even understanding the macro impact and what we're talking about. But
totally. Let's just get into it, though.
Let's see. We might have to fast forward some.
IUL dwarfs whole life.
Yep, there's to get your attention. Dwarfs whole life. Interesting. Dwarf.
This episode, I'm going to address the topic, infinite banking with IUL versus whole life insurance. Get ready, because you're going to understand some things that most whole life agents do not understand. My name's Doug Andrew, and I've helped many, many thousands of people save for their brighter future, for retirement, business owners, real estate.
Kind of a dick, but the cadence is really weird.
Yeah, I'm not a fan. I've always questioned that, and I want to say this too. The title of this is Infinite Banking with IUL versus Whole Life.
Infinite Banking's founder and writer was definitely not an IUL guy. He was 100% whole life.
Nelson Nash would be rolling over in his grave right now if he watched this video. Yeah. Like it's bad.
So that's the author. I actually flew him in, interviewed him twice.
Nice. Amazing guy.
Yeah. Couldn't get to full agreement on numbers and concept, but overall learned a lot from him. And one thing I know is IUL was not in his vision or in the book. So it's
not at all.
It's weird because he's calling it infinite banking concept, but then using his spin, so it's not really infinite banking concept.
Yeah, well, the infinite banking concept, there's a lot of people that are using it in different ways now and probably never even read the book, right? So and they don't understand it. But I mean, this is just an example. Just know, like, you can't do infinite banking with IUL. But
investors, by understanding the merits of max funded life insurance. Now, why do people overfund or maximum fund a life insurance policy? I'm going to explain why and give you the basic difference between whole life and universal life, and why a properly structured maximum funded indexed universal life will knock the socks off of a whole life insurance policy for the...
Just this terminology of knock the socks and dwarf and like all this kind of stuff is just such a weird vernacular for me. I gotta be honest.
Well, I think it's because he's like 75 years old and it's like old school,
it's
like whatever.
Different.
But I will say, I want to say this before he gets into it. He's right. If you're looking at the illustration, an IUL is always going to win on paper.
Right.
It's like if you're comparing whole life to IUL on an illustration.
But we want to compare reality,
but
not just projection, not just...
Exactly, 100%. I think that's important.
Infinite banking concept. So, in a nutshell, for years, there were two types of life insurance: term insurance and whole life insurance. Term insurance is where you are simply paying for the pure cost, the mortality cost, if you happen to pass away. And so you pay a premium based upon your age and your health and so forth, based upon the mortality table. Term insurance does not accumulate cash, generally speaking. And so if you win, you have to die. But see, when you pass away, it pays out a death benefit. So it's a nice way, an inexpensive way to insure yourself. But term insurance gets more...
Okay, here's the first issue. It's an inexpensive way to insure yourself. I disagree, because only 1.1% of policies pay out.
Mm-hmm.
So if you're paying and you don't actually get a payout, was that inexpensive? And he's about to make the point here. It gets more expensive through the years as you get older, but we also have to take into consideration when you pay $1, nothing coming back from that dollar, there's a lost opportunity cost to that dollar.
Right.
What would that money have become if you didn't have to have the term insurance? And so I just think that like that's fundamentally something we should talk about.
Yeah, absolutely. I mean, I think if you look at that and you compared and you said, hey, I'm going to pay $500 a year for 10 years for a premium, you're paying $5,000, right, on that premium. And if you don't die, which is obviously the goal, right?
And what's that $5,000 worth over the next 30 years?
Right. What's the opportunity cost behind that, right?
Yeah.
And so when we look at that and then we compare it to like a whole life policy, that you could absolutely say, I'm going to put $5,000 into a whole life policy, have permanent insurance coverage, and have more cash than you actually put in the policy by that time. And so,
yeah. And so here's one point I want to make that it's not really to do with this video, but I think it's an important thing.
Sure.
I recommend, and this is very different than infinite banking concept.
Okay.
That the first consideration in insurance is the proper amount of insurance.
Okay.
And my belief is I buy insurance for economic value replacement.
Mm-hmm.
That if something would happen to me and I died prematurely, it is part of the solution to indemnify what I would have earned had I stayed alive to perpetuate my legacy and support my family. And so a lot of people reduce the death benefit so much that if they die, they leave their family in harm's way.
Yeah.
And so that's where there is a time and a place for term insurance to get the proper amount. If it's convertible,
I was going to say,
you want a convertible. So regardless of your health, you can convert it to a whole life policy, which might mean it's a little bit more expensive with a whole life company versus just a term shop that only sells term insurance. And
100%.
so that's something you're maybe looking at.
Yep.
And so the right amount of insurance is the first consideration. The right type of insurance is the second consideration. Both important.
Yep.
But I've had people that I'm like, it's probably best for you in this startup phase of your business to have some term insurance.
Totally.
And invest in your business and grow it. When that's more stable and sustainable, then you can convert this. And so that's a really important place for term.
But that's part of planning, right? Like, I mean, chances are, I think maybe.
But infinite banking concept, sometimes sometimes people will skip those steps. And so it becomes about cash value. I'm not saying it's the true nature of it.
Right. I'm
saying some people are saying, you put money in there and the cash value is all they're really taking into consideration. And they actually say, death benefit doesn't matter.
Yeah, I would agree with that. I think the purists that really get it, that's not the angle they come from. But I think there's a lot of people marketing that would tell you, I don't care about the death benefit. I don't care. It's all about the cash value. That's all we're talking about.
But
here.
that's the most leverageable asset in the future.
Right.
And it's the thing that we're protecting. So
it's the thing that basically, it's like the protective wrapper on everything you do in life.
Right.
That's really what it is.
So we're looking at a very simplistic explanation here. And I just want to point that out.
More expensive through the years as you get older. So whole life insurance came around because people wanted to have insurance protection for their whole life, but they didn't want to have to keep paying higher premiums every year that they got older.
Be prepared for something that's not true coming right now.
Because when you're 60, 70, 80 years old, you may not be able to afford those high premiums. So whole life insurance basically said, well, if you pay a high...
And look, like term insurance wasn't designed to be around when you're 60, 70, or 80 years old.
Yeah.
So him saying, well, then you couldn't afford the premiums. It's that the premiums don't make sense.
Right.
Because the insurance company is phasing you out.
Yeah.
That's a different philosophy. So we have to really boil down what's going on.
Right.
That if you kept a term policy from age 20 to age 83, you'd be paying more in premium than the death benefit if you kept it that entire time. So that's why people go with level term or they drop it, because part of the philosophy is I'm going to buy term, I'm going to invest the difference, and one day I won't need insurance because my assets will be insurance.
Totally.
The problem is I only like to pay for insurance if I'm paying less than $1 for $1 of coverage. When I have my assets do my insurance, I'm paying at least $1 for $1 of coverage.
Yep.
So the question is, can I be more efficient transferring that risk to a risk management company, or keeping that risk myself and locking away my assets? So this is the point. If I pay off my mortgage, I have a choice whether I carry homeowners insurance.
True.
If I decide to drop homeowners insurance, let's say it's $2,500 for my $1 million home. It's a pretty expensive policy.
Yeah. Yeah.
And I go, I can now save the $2,500.
Self-insure.
Exactly. I have to have some amount of money set aside relatively liquid and safe in case something happens to my home.
Yep.
And by the way, what if I did that in 2020 and had to rebuild in 2021 because it burned down? Cost of materials and cost of labor skyrocketed because of the demand and supply chain issues.
Yep.
So I actually am now losing so much more than $2,500 if the home never burns down or we never have a claim.
Sure.
Because I cannot properly invest my $1 million because I have to use it to protect my home.
Yep.
And that's what people aren't thinking about.
Totally.
They're thinking about saving more than they're thinking about growing and investing.
Yep.
And it's kind of a
Well,
scarcity
it's that
mindset.
scarcity mindset versus the
exactly.
abundant mindset and the growth mindset. Yeah, absolutely.
So anyway, just a little notation there.
Your premium in the early years, you're going to be way overpaying in the early years, but that will build up.
Okay, let me give you that.
Yeah,
I'm going to just toss that to you.
Yeah, listen, his whole concept here is he's saying that you're going to pay more for whole life in the early years and you're going to pay less for it later comparatively to term. I'll tell you what he's doing right now, and I haven't watched this whole video. This is about what we watched too, and we said, okay, we'll review this video. We'll see this one. I guarantee he's going to pivot at some point in time talking about how Index Universal Life is a cheaper version of life insurance than whole life. That's what he's going to say. I'll bet you
That's
right
your
now
prediction.
$100 on this.
And do you believe that whole life is overfunding up front and then having it level in the future because you've overpaid up front?
No, like that is not how it works. Like, listen, so you just described how term insurance works. It's a contract. There is no free lunch in the life insurance game, right? Like, so it's all actuarially driven. It's all a contract. So if I buy a 10-year term policy, if I buy an annual renewable term, I have an agreement with the company.
Every year it could go up.
Every year it's going to go up, and there's certain terms about the rules of my insurability at the end of every year, or every period of term, time, whatever that is. I could buy a 10-year term. I've got insurance on a guarantee basis for 10 years. If I get 15, 20, 30, like it is what it is. It's all about actuarial risk. When you get a whole life policy, they're basically saying, hey, like we're gonna take your life expectancy. Now, whole life insurance has evolved, right? There's policies now that are paid up at 65, like purely. The traditional ones are now like 99 to 120 or full pay. The longer out you go, actuarially speaking, they take your total mortality expectancy and they put it into a calculator and they level out the premiums, and that is what it is. Because and is it a little more expensive on the front end? Sure it is. But it's level and it's predictable and it's controllable. And you know that as you get older, it's just going to get better and better and better. You're going to have control, and the liquidity in the policy, like from a cash value perspective, I don't know where he goes with that. I guess we'll have to see. But, like I look at this and I go, you're not overpaying. And I think maybe what he's saying is that technically speaking, and I can't stand this term or this definition, is that dividends paid back to the policy are technically what return of premium of an overpayment,
which is part of why it's got the tax benefit.
Which is why it's got the tax benefit, and that's one of Dave Ramsey's big arguments, right? And that's what he's saying right here. If that were the case, if I were paying in $10,000 a year a premium, and I was getting a return of premium in the form of a dividend because I got overcharged,
then you wouldn't ever be able to be in a positive return in that policy.
I would never be able to have more cash value in the policy
than what you put in,
than what I've contributed. Right. Yet every single policy I've ever done
is set up like that.
Is always set up that way. So explain.
So that's why I think that
makes
good.
No sense.
Yeah.
Up equity in your policy. It's called cash value, and that will cover you for your whole life because you overpay the early years, which allows you to underpay the later years because you have cash that's earning interest inside that whole life policy that allows you to pay a level premium your whole life, and you have enough cash buildup that the interest on that and that cash value will make up the difference in your later.
The deal is, though, contractually, that your premium could never go up.
Correct.
Right?
Correct. For whole life.
For whole life. Mm-hmm. But so what he's saying here is that you've overpaid, and the interest that's earned in the future is what keeps the policy premium level. But then why could you eventually take a reduced paid up policy and have the same amount as your original death benefit?
Right.
That debunks that. So that's where you reduce it because the death benefit could grow over time. And it feels like the 13-year mark is where that starts to really flip to a much higher, rate. So he's saying that it's the interest that's keeping that level.
Yeah, he is. And here's what I'll say. What he's saying to me, even if he's right, like let's say if he's right, to me, like I always like try to see both sides of the argument, right? Like let's say he's right. He's saying you're overpaying up front to pay less later. So if I'm overpaying a little bit more when I'm young and healthy and my costs are low, but I'm underpaying later when my costs would be higher and my risk is high, like to me, even if he's right, which he's not, that'd be a good deal. Whereas with IUL, you underpay early when costs are cheaper anyway, and now you're overpaying later.
When he just kind of slammed term insurance to a degree.
Yeah.
Not mentioning the chassis
of IUL.
IUL is built on annual renewable term.
Yep.
So it's going to be interesting to see where he takes this.
Yeah.
For years. That's called whole life. And so whole life has guarantees. Life insurance ever since the 1980s was built on a chassis that was based upon a 4% guaranteed fixed interest rate. Well,
okay, first off, the 4% guaranteed interest rate, I've only been with insurance companies that have always paid a dividend above the guaranteed interest rate, number one.
Correct.
Number two, and I'm talking 100-year minimum is my threshold.
Yep.
Number two, it's not even actually 4% on the guarantee because there's a cost of insurance. So like on the whole life side, you're not getting 4%.
That's the gross.
It's less than that after insurance expenses. But then there's dividends that get paid from a mutual like company, especially that's saying, hey, we're participating, you're participating in the growth and the benefits of the company. And so there's companies out there, a dozen, that have always paid more than the minimum guaranteed. Once they're paid, it becomes the new minimum guaranteed. So this notion of 4% guaranteed fixed interest rate is contractually accurate. Not the reality of what you'd get if you got paid the guaranteed. It would be after expenses, so it would be negative for several years and take a long time if it ever broke even. And ultimately, the dividend negates that because once it's paid, it becomes a new guarantee.
Yeah, and
hopefully that's not too confusing the way I said it.
You're 100% accurate. I don't think it was too confusing at all. But I would also say he just said life insurance since the 80s is built on 4%. I know he was talking about whole life insurance before, but then he just said life insurance in general as a blanket statement. But the reality is in early 80s, UL came out.
Right.
And that was not, that didn't have 4%.
Wasn't it 78 that E.F. Hutton came out with the first policy?
And so
45 years ago.
He's saying cash value. He basically
but
pivoted
this has
and made
been
it
around
sound like
for a long, whole life's been around much longer than that.
Much longer than that. And UL came out, it didn't have a 4% guarantee.
Although the really old whole life didn't really grow in death benefit.
Not the
It was
same
just
way.
this cash value thing that went up, and you know it's changed over time.
The really old whole life was all basically 100% base style policies.
Right. There was no what's called
paid up editions.
PUA, paid up editions, where you could put more in to fuel it.
Right.
Which he's calling max funded is one of the terms he's using.
Right.
Yeah.
Well, whole life has merits because it's structured to be able to give those guarantees. But in a low interest environment like we have been in recently, where a lot of banks and so forth and the Fed rates and the U.S. Treasuries are under 1%, how are insurance companies going to continue to be able to cover you for your whole?
Well, first off, let's talk about that in the general fund. One of the unique things that insurance companies can do is have a 30-year bond that most individuals don't, because if they can hold it to maturity, they can take the higher interest rate years and lock that in. But ironically, there's three things that help them out. Policy loans. Because people are taking policy loans, that interest then comes in. Number two, the cost of insurance, especially term insurance, because when people pay for term and never make a claim, it helps enhance the dividend.
It's a profit center.
And the other profit center is IUL, because they can change the cost to a guaranteed cost versus the current cost to help support. So the very thing he's teaching is how they do it. And by the way, now interest rates are much higher.
That was where I was
5%,
He's like, what are we going to do with 1%
7%,
interest rates?
And so he's looking at the worst case scenario, which is great news because I had my policies during those times,
and they still
and I'm great with that.
Yep.
And by the way, when there was really low interest rates and there was other opportunity, I used the cash to acquire assets. Now, it'd be fine if I never did, but it's something that I find to be interesting here. And so, ironically, the very thing that he's bagging on, his policy helps support.
Absolutely.
Life based upon 4% when they're not able to earn 4% maybe. This is putting insurance companies into a bind. And so that's why.
He's also not talking about the arbitrage that happens for insurance companies due to policy lapsing.
Right. Like breakage.
So that that people cancel, they switch. There's just all this stuff because there's more upfront expense to every IUL, any cash value policy, because there's surrender charges in the IUL. So that's interesting here. That's what he's trying to say.
Yep.
Because interest rates have changed drastically since he filmed this video, and it was not that long ago because he was talking about 2020.
Yeah. So
well,
it was after the Section 7702 change, because I know he meant
in the wee hours of the very end of the year 2020, Congress passed, as part of that big stimulus legislation, changes to Section 7702 of the Internal Revenue Code. I have other episodes I'm going to be releasing that explain this, but that is going to take the guarantee down to 2%. So the guarantees inside of whole life are not going to mean that much.
Okay, so how many policies went to 2%?
A fair amount.
Okay.
A fair amount.
But did all of them go to 2%?
No. So the Section 7702 rule doesn't say whole life guarantees have to go to 2%. It says whole life guarantees can go down to between 2 and 3.75%. And really what it did.
And again, whole life policy that is in existence with Mass Mutual, Penn Mutual, Guardian have paid the guarantee.
They always pay the dividend above and beyond.
Always.
They've never, ever.
They could absolutely go to the guarantee.
But we haven't seen it in 180 years.
He's saying after 180 years, something that hasn't happened in 180 years, as if this is the common thing.
Right.
Doug, come on, bro.
I know.
Come on, dude.
It's nuts. And here's what I'll also say. So the 2%, he's touting the 2% guarantee now as a negative.
And he's going to go to 0% with his IUL.
Right. Well, and the deal is the 2% and I'm going to get a little nerdy for a second, but the 2% to 3.75% flexibility, what that did was, he's right. There was stress on the general funds. Bad monetary policy, low interest rates, that put stress and pressure on life insurance companies.
And guess what? Interest rates in banking was 0.25%.
And I got news for you. When the
1%.
general fund performs poorly, we did a video on this. What does that do? The general fund performs poorly.
It hurts IUL massively.
Massively. Why? Because the options budget goes smaller, and as the options budget goes down and the options costs go up,
you'll have to look. Maybe we can have a link to that because he's absolutely missing the point.
It's nuts.
Yeah.
What they do when they drop that to 2 to 3.75%, it provides flexibility for the life insurance company to have a little bit more ability to manage based on their unique general fund allocations.
Right.
Anymore. Whole life insurance is going to have to perform based upon dividends and interest.
They always have.
For
I can prove to you that indexed universal life will knock the socks off of whole.
I can't wait for him to prove this. But again, with the money that they take to buy the options, low interest rate environments have created pressure and problems. That's why what the cap rates used to be really high or higher with indexed universal life, and they continue to go down. That's to go from like 14.5% to 8% is much worse than going from 4 to 3.25.
3.75. Yeah.
3.7.
Yeah.
And again,
he's probably going to prove it to us with an illustration that has no backing.
Can't wait.
We'll see.
Life as far as rates of return, and that's because of the historical average rates of return, but also if you're using life insurance for what is called infinite banking to become your own banker, indexed universal life.
Dude, Nelson Nash that wrote that book. He would be, can you imagine?
I can't believe the Nelson Nash Institute hasn't come after him about this
and say we're going to dwarf you.
Will dwarf what whole life insurance can do. So let me explain why and how. Now, if what I've said so far is intriguing you, subscribe to this three-dimensional wealth channel. It's free, and I post an in-depth answer to questions.
It's not free. It's one of the most expensive things you could do because you're going to listen to this. And the worst advice sometimes is the free advice.
Almost daily. And as this topic relates to several others, you will gain insights into how to maximum fund an insurance policy see universal life versus whole life. There's a lot of people out there that tout that whole life is better, and they usually quote the guarantee.
You know what? There's actually a lot more people that touting IUL is better than whole life. So let's just be clear about that. And they usually quote the guarantees. Well, all right. Like I'm saying, once a dividend's paid, it becomes guaranteed. I would never look, if whole life only paid the guaranteed interest rate from beginning to end right now,
worst case scenario,
I might start looking right now at being like, well, would it make sense to be in a muni bond and buy a term? I would look at that.
Sure, of course.
Because if it really were 2%,
right?
But it's not.
But it's not.
I've owned a policy since 1998. So like as a young, I was told yesterday at the ballet, because I know they wanted a good tip. They're like, you look too young to have an 18-year-old. And I thought,
nice.
I thought I did give an extra tip.
Yeah.
I mean,
it worked.
It
worked.
happened. Yeah.
That's all changing. So as this evolves, especially now, you're going to want to tune in and see how you can benefit yourself, and why indexed universal life, I think, is by far the best.
And before you tune in, maybe just type in Doug Andrew lawsuit.
Yeah, I would do that.
There's been a lot.
Yeah,
been an awful lot.
Definitely.
Yeah.
Product if you want to accumulate tax-free capital. If all you want is death benefit, whole life's a pretty good product, but universal life can still do well. But with universal life, you're self-insuring. In the policies that
What?
You're
I don't know
self-insuring?
what but with universal life, you're self-insured. Like,
I can't wait to
explain
hear
this,
how.
Doug.
most people are self-insured within 10 to 15 years, meaning the cash inside the insurance policy is within 5% of the death benefit within 15 years. So the cost of the
He's talking about the net amount at risk. That's what he's talking about. He's saying the cash value of a max-funded universal life policy will be within 5% of what your death benefit is if you chose option 1 and max-funded, I think.
No.
I think that's what he's saying, right?
I guess.
Hopefully it shows an illustration.
Yeah.
insurance is next to nothing.
The cost of insurance is next to nothing.
Are you legally allowed? Are you compliantly allowed to say that?
Okay, so first off, what he's saying is the insurance companies are being duped.
Yeah. Yeah, you're
They're
smarter.
being duped
Doug's smarter than the insurance
term
companies.
and whole life makes them money, but index universal life, they're going to charge next to nothing.
It's funny how IUL charges next to nothing, but it's the greatest profit center of all the companies that sell it. It's
wild
interesting
what
how
he's
that
saying
works.
here, man.
In other words, if you put in $500,000 and the amount of insurance required for it to be tax-free for a 60-year-old with $1,250,000, that $500,000 has grown to $1 million within 7 to 10 years, and in another 7 to 10 years, it's going to grow to $2 million. Well, that's more than the insurance. So the insurance stays ahead of it by 5 percentage points.
Okay.
It's funny how he's talking.
It's more than the insurance. First off, we have MEC issues, modified endowment contract, and so there's like he's really walking a legal line with what he's saying here.
He does some stuff, I know, when it comes to doing 5-pay, really high front loading up to the guideline level premiums, and it illustrates really well, but it doesn't perform that way.
Indexed universal life is by far the cheapest insurance policy when it's structured properly you will ever see, because it gets cheaper as you get older.
Okay, first of all, that can't be true, because let's break it down. We've done it before.
Yeah.
It's built upon annual renewable term.
Right.
Where and so there's a mortality experience. The older you get, the more the cost of insurance goes up. But what he's talking about is something called the net amount at risk. Mm-hmm. The net amount at risk is the death benefit minus the cash value is what you're being charged for on the insurance. So he's saying because the cash value is growing, you have less net amount at risk, but we also have your mortality going up and increasing, like he said, with term, where it's getting expensive every year, more expensive every year. But because there's less amount that's being charged, if you just leave it as is, that's where he's being somewhat accurate on the net amount of risk.
There's a possibility to be accurate.
Right. But that's what he's talking about. But he's also not talking about mortality experience.
No, he's not. And we don't know what the insurance companies are going to do. But I kind of look at it and say, well, what have they done in the past? And in the past, they've always raised charges, and they've always raised the fees, and the mortality costs have gone up. And so
he's been in this for 45 years, he said.
Yeah, I mean, which
so
is
what
before
I want,
IUL
Doug,
existed.
why don't you show the very first IUL that you got people into and how it's performing today.
Yeah. And
because that should have millions and millions of dollars, because it's doubling every 7 to 10 years, tax free. They should be able to take a ton of money out of it. There should be no insurance expense. I want to see this because he's been doing this for so long. Like, look, I can go to my policy that I did at a mere $50 a month 25 years ago and show that. I can show clients for years. Like, sure. But like, I want to see this from this long ago.
He'll never show it.
Don't need guarantees because the cash equals the death benefit, or almost equals it, based upon the TEFRA tax citations, which I explain in other episodes.
Doesn't show it.
Now, let me explain why people would even consider using an insurance policy as their own bank. Life insurance for over 100 years is a sacred cow. In the Internal Revenue Code, under Section 72E, 7702, and 101A, it explains that money inside of a permanent life insurance policy, and by the way, indexed universal life didn't come out until 1997. Universal life came out in 1980. Who came up with it? It wasn't an insurance company. It was a brokerage firm, E.F. Hutton. This is where I immediately recognize this is like buy term and invest the difference under a tax-free umbrella. It's like on steroids.
Yeah, and guess what? Term insurance gets more expensive as time goes on. He already said it at the very beginning. So I'm like, where's your argument going? And like on steroids, I don't know if everybody knows, but like steroids have a whole lot of side effects.
They do.
Did you know? Like, I think your balls get massive, but you can't get an erection.
No,
you get zits all over your arms.
Yes,
like,
exactly.
Like, hey, man, this is like a deformed policy, is what I'm hearing when he says put on steroids.
That's awesome.
Look at the face. I keep positive on the best things.
Well, it's true when you use universal life for the infinite banking.
Which is absolutely not anything the Infinite Banking Concept Institute would ever endorse.
Like, all I can tell you, like, what do you need for banking? You need guarantees. All I would say, if you want to think about banking with an IUL policy, look at the guarantees in the policy. Like, that's it.
Well, the more you use it, the more we can have some issues and risk, because 40% of the time, it's not performing at the level that it's shown year to year on the illustration.
On the illustration, correct.
Concept. It's like infinite banking on steroids. So TEFRA, DEFRA, and TAMRA are tax citations. Section 72E, 7702, and 101A say that when you put money into an insurance policy and you take the least amount of insurance the IRS will let you get away with, it accumulates your money tax-free. You can access that money tax-free. And when you die, it blossoms. It increases in value and transfers income tax-free. Nothing else does that I'm aware of in the Internal Revenue Code.
Yeah, let's talk about that.
Go ahead, start.
Whole life?
I mean, yeah, I like, there's nothing else. I mean, Whole Life I think Whole Life's been doing it a lot longer. Whole Life's been doing it a lot more predictably, consistently.
And let's just talk about businesses and real estate. Let's talk about real estate, for example.
Cool.
Real estate, you can depreciate for tax purposes. You can 1031 it to another like-kind asset, not pay tax on it. You can borrow money against it, tax-free.
Leverage.
You can pass it on to the next generation with a step-up in basis, which means it goes to them without tax. Sounds like
pretty awesome.
Maybe we cracked the code.
This is where I have earned a return of 6%, 8%, 10%.
Okay, I want to see the 10.
I
challenge you. Show us the illustration. In-force illustration. That shows 10%. Real illustration. Not for 1 year.
That's more than 10 years old.
Yeah.
A policy that's more than 10 years old that is done 10%.
And he says net. He's talking about net.
Net.
Doug, show it. Pull it up on the screen, bro.
Like,
let's see this, man.
Gosh.
Net internal rate of return cash on cash. Now, since it's sort of a sacred cow, whole life.
I've trademarked that term. You can't be using sacred cow. I wrote killing sacred cows.
You got an issue with this?
And we're killing some sacred cows today, Dougie.
Insurance oftentimes has been touted for infinite banking because when you build up this cash value and the guarantees were based upon 4%.
Again, why are we talking about 4%?
Right.
When this thing has always paid a dividend. Now, okay, if we're going to compare apples to apples here, Dougie, you need to now only talk about the guarantees of your policy, which, by the way, have been enacted. Guaranteed, there's been a year where you got the guaranteed nothing because the market went down.
Correct.
So we're talking about whole lives that we have that have never paid the guarantee, always paid more. And you saying that that's what you can expect.
Yep.
And by the way, if we're going to talk guarantees, let's talk about the guaranteed cost side of your plan since you say it's nearly free or whatever the hell you said. Like, I want to be nice because I've met you before, but come on, dude.
Well, we just did this video. What did we do? We went through. We dismantled and we showed on their illustration. Somebody had $240,000 of premium, and we looked at it was 120 whatever thousand in charges. That didn't even cover the loan expenses.
What about the nearly free? I thought it was going to be nearly free.
I don't know. Yeah. We have a different definition of
borrow money out of your whole life policy, and they'll charge you a nominal interest rate, and then they'll keep crediting you a little bit higher interest rate. So if you borrowed,
whoa.
Okay, let's go here. Let's go here because, again, he's going to talk about wash loans or index
no, he's
loans,
using the index loans. He's talking
riskier.
about you're gonna borrow at a percent.
But there's something called direct recognition where you can borrow from your policy in a whole life, and you're going to get credited the same rate.
Correct.
So like. Again, like, stop with the misinformation here.
Right.
You might be guaranteed 4, so you're being guaranteed twice as much as they're charging you, which is good.
No, that doesn't work that way. It doesn't work that way.
What is he talking about?
You can't go in a whole life policy and borrow at 2% and get 4.
No.
That's not an arbitrage structure in here.
No.
All they've ever been able to say is, well, Universal Life doesn't have the guarantees.
Well, Universal Life has a general fund and then the
options
strategy. Cost.
That's it.
Right?
Yeah.
And a minimum guarantee and then a maximum.
Right.
But there's still the guaranteed cost can go up from where you started.
Of course, the guaranteed cost can go up, and there are variables outside of you're not.
And dividends aren't guaranteed in a whole life, but once they're paid, they are.
Right. And he keeps saying, look at the market history. Your performance of an IUL, Doug, has nothing to do with what the market does.
Doug, you got to watch this video that Chris and I did.
You'll learn a lot.
We'll definitely send you the link, dude. I'll email it to you.
His whole life has. Well, looks like the guarantees are going to go down to 2%.
Again. With the misinformation.
Yep.
Even if the guarantees do go down to 2%,
yep.
We're talking about companies that for over 100 years have always paid a dividend above the guarantee.
Yep.
So why are you comparing if you even are calling this index the stock market, which is everybody knows is not guaranteed.
And not even accurate.
Everybody knows is not guaranteed to a guarantee, but not including the dividend performance against your stock market performance.
Right.
It's mind-numbing and blowing, and it's a straight-up lie.
Yep.
So that's not such a big deal anymore, and it never has been with Universal Life because the cost of insurance, I don't need the guarantee anymore because my cash grows to equal the death benefit, and the death benefit then stays ahead of it by 5%.
Okay, it equals the death benefit. That is not possible.
No.
Show me one illustration.
So what he's saying is that the death benefit or the cash value goes up, the death benefit's going to stay level, and then the cash value will get up to the death benefit, and then there will always be a little gap,
5 percentage point
gap. So if you have $1 million, if you have $1 million of cash, he's saying you'll have 1.05, 1,050,000. So they're going to have 50,000 net amount at risk, the death benefit minus the cash value. That's what he's saying. But
show me one policy.
Show me one policy that's
one policy where it's only 5%. One, please.
Yep. That's been in force for 10 years.
I know you ride bikes. I'll buy you a Harley.
Yep. Yeah, exactly.
You in?
Yeah, let's do it.
All right.
Percentage points. If I have $2 million of cash value, the death benefit's going to be $2.1 million. If I end up with $4 million of insurance, then the death benefit's going to be $4.2 million.
Show me one.
Show me.
So the cost of insurance goes down as you get older.
By the way, it's going to illustrate showing.
By the way, but that is not true. Your cost of insurance doesn't go down as you get older. Your mortality goes up.
Right.
The net amount at risk he's saying is going down, so less is being charged. But technically, if we're being legal about this, that is illegal to say the cost of insurance goes down as you get older.
I don't know how he gets away with
started this by saying term insurance gets more expensive.
I guess he's
as you get
looking
older.
for another lawsuit, Garrett. Like he's just.
Now I explained this in other episodes. But let me share with you why the banking concept is so dynamic with indexed universal life compared to whole life. With indexed universal life insurance, I have 2 ways that I can.
Okay, here we go. This is wash loan. Versus indexed or whatever.
Or participant.
Zero wash loan. So let's say I have $1 million of cash value.
Which, by the way, direct recognition is very similar to a wash loan.
Correct.
So whole life has direct recognition. They have wash loan. It's very similar.
Bingo.
If it's 100,000, $1 million, or 10 million, people use their insurance.
He's about to talk about arbitrage in a way that is so unlikely to happen that I'd love to see the statistics.
For the a banking concept to buy real estate, to use for working capital for business and so forth. If you don't understand this concept, watch other episodes where I explain how to become your own banker.
How many times does he reference that?
He's good at selling.
Yeah.
Value. If it was a whole life policy, I could borrow that and they will credit me a little bit higher interest rate, and I'm paying myself.
They don't actually credit you a higher interest rate.
No. Well, they potentially
they
could.
There was that time period for sure,
circumstantial.
Right, but it's not the typical thing.
It's not the principle.
Yeah, it's not the principle.
Money back into the policy and so forth. Folks, that's okay. Yeah, if you borrow it too and you earn 4% is 100% more than 2%. I get it. But those guarantees are going down.
Again.
What does that have to even do with what he just said?
Nothing.
It's completely unrelated.
I've always been able to borrow it too, and they credit.
Which, by the way, sorry, but like he's talking to a bunch of people that don't know what they don't know. Right.
Which would have been me if I wasn't in this industry.
Right. And he's just
which would have been you if you weren't in this industry.
And he's just speaking about things that people don't understand. He's speaking to IUL agents that don't understand whole life. And so he's speaking like, you know, it's mind numbing. Like, and I know he knows what he's doing.
Right.
Like, it drives me freaking crazy.
How do you feel about it?
Well, that's a wash. Well, that's not the way I usually borrow. I can do that. I opt for the indexed or participating loan.
Yep.
This is where the insurance company goes, well, you can leave your money with us as collateral, and we'll keep crediting you whatever the index or indices that you're linked to are earning. So many, many years.
That's a lie.
Okay,
so,
wait. He said I earned 10%, 16, 25, or even 55. We got to get
Let's
to
see
that.
this.
Okay,
let's see this. Okay, we'll listen to this and then we'll react.
I have earned 10%, 16, 25, even 55%. Some years I don't earn that, but the average has been 8, 9, 10%. So to keep it simple.
How is he earning 55%, dude?
Say 10.
To keep it simple, just say, let's assume we're going to make 10% in our IUL, just hypothetically.
By the way, so he thinks Warren Buffett's an idiot. Because Warren Buffett's like, hey, if you can get 6% in the market long term.
Doug Andrews way smarter than Warren.
Yeah.
You know, like obviously. So here, let me explain how this is going. IUL has had an interesting history.
The problem is he's going to be dead when all this stuff implodes on his clients.
Yeah, but his son and his
kids are going
to have to inherit. But I mean, his son, you know, has already been involved in plenty of lawsuits. Which, by the way, guys, go look up Aaron Andrews' lawsuit. Like they've all got it. Like the fact that people don't see it is mind numbing to me. But
I got to admit, they got cojones to keep saying this stuff. It takes some cojones.
I don't know how compliance with these companies is allowing him to get away with this stuff. Like it is straight up inaccurate, and it's straight up lying. Because I know
I feel bad because I've had a nice conversation with him. I didn't know all this. I didn't know any of this until someone sent me a video to react to, and I reacted, but I didn't hit record.
He's probably using your book to sell his product at this point.
I doubt it, because
but no.
got his laser phone.
So here's the deal, though. IUL has had an interesting history in the sense that, you know, it back in 2010, people were illustrating these things at 10%, like, and being like, oh, the cap rate was 18%, right? Like, and it was nuts because options were low because we were coming out of the Great Recession, so options were low. Not a lot of people because the market was going up.
Yep.
Like,
So
it is what it is.
A
like,
couple good years.
They had a couple good years where it was illustrating the general fund because the interest rates back then were higher, right? So general fund was creating higher options budget, cost of options were low, cap rate, those determined the cap rates, par rates, and all that stuff. We went through, had all this stuff happen in 2019, 2018. A lot of companies started entertaining the idea of no cap indexes. So that's where he's saying I can get 23 and 55% and whatever annually. There are situations where if you do point to point and they got in at the very bottom
today.
I've seen them, and
Today?
It's happened. It's happened.
Even today?
It's happened. If you go through and but it's not the whole policy. It's if you pick the bottom of COVID, when the market crashed, the day it hit the bottom, and then the annual point to point where you got in that day and you ended on the next year on the anniversary at the peak, it was like 54, 55%. Like that is a unicorn situation. You cannot plan for that. You know what I mean? And he's using and so the guy's sold thousands of policies, I'm sure, throughout his career or whatever, and his agency and his organization. He's got 115,000 subs, so I'm sure he's, you know, got a lot of clients out of it. And he does other marketing. And so I'm sure he's got a client that got to take advantage of that. And I'm sure he got really excited and he made a YouTube video on it, right? and is showing everybody, see what you can do. I got news for you. That's not going to happen for you 99.99999% of the time.
Yeah.
So
Okay.
just know that.
If I'm earning 10%,
And this 10% thing,
like,
I'm sorry.
Where's it coming from? Where's the 10% happening?
It's in his dreams.
Right.
Like,
an indexed or participating loan, they're going to charge you a little bit higher interest. So they might charge me 4 or 5%. Let's say 5. So they're charging me 5% to borrow on an index loan. So on that $1 million I borrow, they're going to charge $50,000. Do I have to write out a check for that?
No.
No. It's really just sort of a phantom loan in the first place, but they deduct the $50,000.
Okay, that we have to go back to that. It's a phantom loan in the first place.
it's like, how does he get away with saying that? It's a loan, guys. It's
a
not.
loan.
There's nothing
You will get
phantom about it.
statements on
It
it.
actually exists.
You will get
Like,
statements on it.
You will get statements
There
on
is
it.
interest on it.
And there's a liability on it because guess what? He's talking about if you pay 5%, it's $50,000 of the loan expense. He's assuming you're going to get better than 5% return in the market. What if the S&P 500 or whatever index you're in does 0 that year? You have to come out of pocket or use cash value in the policy to pay that expense. Like
From the $100,000 I earned that year. Because if I earn 10%,
What if he takes the money out and loses it? Because here's one thing I know about Doug and his organization. When they were pulling equity out of people's properties,
Yes.
they lost that money in certain investments.
Yeah, I mean, they got in trouble with the whole Woodbridge thing, right? Like, which was a Ponzi scheme, right? So putting people into policies, borrowing against the policies, putting it into that's where a lot of trouble happens, right? Like,
on my $1 million that is still sitting in the policy that's being used as collateral for the $1 million they loan me at 5%, I'm earning 100% more than the cost of the funds. So I'm earning $50,000. It's way better.
no, you're not. First of all,
it's way better than a measly 2%.
yeah, well, guess
Show
what?
Show me the policy that has been around for 20 years that only earned 2%.
Right, exactly. Well, he's
Using the same max
assuming,
funded
but
philosophy.
he's assuming there's 2% positive arbitrage in whole life, which is, by the way, not a
that's
fair
not- yeah.
comparison. It's not even accurate in the first place.
It's just dumb.
Maybe in a whole life policy. But do you know that I have had
But even then, remember when he said, if you go from 2 to 4, that's 100%.
Right.
And now he's calling it measly 2%.
Right, measly
so which
2%.
is it? Is it
Right.
measly 2 or
That's a good
100%?
point.
That's a big difference.
And in the whole life version of this,
Dude,
by the way,
I don't know if I can handle reacting to these videos, dude. I it's so painful because it's so problematic to the people that buy them.
and he's got so much influence. It's insane. If you knew how many people this guy was influencing from World Financial Group, PHP, PFA, he is the crux of the problem in the industry, in my opinion.
many clients who, for their business, for their real estate management, where they borrow money to build or to buy real estate properties.
Like I still want to see the $1 million policy of cash to the $1,050,000 death benefit. I want to see it.
I do too.
I want to see the year of your policy where you got 55% and where you've averaged 10% in your policy for the life. Like
Totally.
the actual net, you said. I want to see those. Show them. I want to see them on your channel. Pull them up. Show that.
Money at 5%, and they have earned sometimes 16, 20,
That is egregious right there.
55% on indexed universal life. In other words, you borrow $1 million, they charge you $50,000. It's deducted automatically from the 25% that people earned in 2017, for example. They paid you $250,000.
First of all, these policies,
They don't exist.
in 2017.
Indexed universal life will dwarf whole life as far as the spread. What's the spread? The difference between the net cost to borrow and the net amount you're earning on the compounding inside the policy.
What happens when it's 0% that year?
Yeah, exactly. He's really good at talking about the upside.
You don't make money that year. Here's the scenario. It's 2008. Let's go to 2008. You'll make 0 in the policy.
Yep.
And wherever you invest the $100,000, you lost it.
Gone.
Even worse, you use the $100,000 as a down payment on a property. Now you owe on the property that's not even worth what you bought it for. So the $100,000's gone, and you still have to make payments unless you go bankrupt. Let's talk about that.
Right. Exactly.
And the longer it goes, if you keep earning 100% more than they're charging you.
Okay.
If you keep
earning 100%. Okay. Everyone watching, what I want you to do, I want you to take a calculator, find a future value calculator, find it online, put in any amount of money. I don't care.
It could be a penny.
Any money, and I want you to put 100% return for 50 years.
That's amazing.
and you now are the richest person
You're
on
Solomon.
the planet.
You're Solomon.
You have more money than the U.S. The Rothschilds are upset because you have more money. Jeff Bezos is a pissant at that point. Like, come on, dude. If you just keep earning 100%,
you got this. You
just 100%. Just 100%.
Hey, good news. You got an IUL policy
just
somewhere, right? Like, you could
dude.
go do this.
Oh my God, I have one. I haven't been doing this.
This one compounds and grows tax-free. Pretty soon, you're earning, let's say 10% on twice as much.
100%, 10%, 0%, 55, 26. Do I hear another number? Throw out a number.
Fired up about this as me.
That you're paying interest on. But as it grows, you can keep borrowing more money. This just keeps getting better and better and better as you go. So if you're intrigued with infinite banking, becoming your own banker, I can show you, I can illustrate that a properly structured indexed universal life insurance policy will actually perform far better for infinite banking than whole life. And I've had many whole life agents, when they finally listened and they finally saw the illustrations, they went, oh my heavens.
Oh,
there we go. There it is.
Oh my God.
There
when
it
you
is.
saw the
When
illustrations
they saw the illustration, hold on.
that never matter.
I have an illustration for you. 20 million. 20 million. Just picture the illustration in your head. 20. Do you want 20 million or do you want 200,000?
Yeah, exactly.
All you got to do is earn 100% year in and year out, which Ray Dalio never did. Warren Buffett never did. But you know who did? My buddy Doug. My buddy Doug. He's killing it.
This knocks the socks off of whole life. Yes, it does.
Dwarf knock the socks. Yes, it does.
They say whole life is better and IUL is not. They don't know what
I don't
they
know.
don't know.
You know, I don't know what I don't know.
I don't.
I just wrote What with Rockfest.
Dude.
Killing Steakhouse. I just have been doing policies that I can actually show that are 25 years old. I want to see his policy that he started in 1980 because he was in the business.
He was, and my guess is he did UL before IUL.
Right, and I want to know. Like, let's see your history here.
Yeah.
Make sure you don't make the mistake of doing something that's good when you could have done something that was better or even best. So if this is intriguing you, subscribe.
Please don't.
Please don't.
Please don't subscribe to this channel. Okay, dude. Why?
And if you
my
have,
blood pressure's so. I had just been working to get it down, and I had taken it the other day, and it was the best it had ever been. And now
it's ruined.
It's so frustrating.
It's so good for you. Now you're
got to watch our other videos because our other videos dissect this and show and verify what's going on versus just throwing philosophies out there.
So
just 100%.
I know. Just
arbitrage 100%.
I mean, seriously. First of all, that was
I earned 55%.
That was a 15-minute video, right? And that 15-minute video, how many times did he say the same thing over and over?
Knock your socks off, dwarf.
Dwarf. Yeah.
You know the terms? What are the different terms? Tephra,
Defra, Tamra,
7702,
7702,
whatever B,
72A, like all the, like he does that all the time, and that's fine. Like here, but the bottom line is when you're just talking, he didn't show anything there, right? And he's talking in this like general theory philosophically about like illustrations that, by the way, don't matter. Like illustrations don't matter. He's,
you know, it reminds me of. I
God, it drives me nuts.
So I had this friend in college, and my wife was friends with him in high school, and he just would say the craziest stuff. Like, my mom was in the hospital. She was just there for so long they made her a doctor. I'm not lying. And then he had this. His parents had this little house, and he's like, "Oh yeah, there's 2 vipers in the garage." Like, this house definitely doesn't have 2 vipers in the garage. And then he's like, yeah, I was a dart champion at 12. I mean, you're not legally allowed to go in the bars, but they let me in because I was so good. And so he'd always tell these stories. And one day I was drunk and we're at this bar and he's saying something. I go, oh, he had just said, you know that big project that happened in Cottonwood? I'm like, yeah. He's like, yeah, they made me the lead architect. I'm like, oh my god. He didn't go to school for architecture, right? And this is a major, like, huge commercial. And so drunk, I look at him, I go, you know what I did? It's like, what? I'm like, I jumped over the mountain the other day. Just flat-footed, jumped over the Wasatch Mountains. Actually, it was right over Olympus. It was amazing. And he could tell, like, I was just being a total dick, and walked away. And then we just laughed. But that's what this reminds me of.
Yeah, totally.
Just say crazy things.
But here's the deal:
that with no validation or proof,
he's taking
and he's acting like this happens all the time. So show us one. We're not even asking for the 10-year. Old policy for 100 people. Show us one that's 5%, just barely trailing behind. No cost of insurance or next to nothing. the 55% return on point to point.
Yep.
The 10% a year,
Well, the
year in and year out.
55% point to point, I know he's done it
Right,
one
but
time.
One time, I want to see.
Show me 10 policies out of all the hundreds that you've done, thousands that you've. Show me 10 policies that have done it. Show me 5.
Show me where the index was doing, where you're paying 50, making 100, and arbitraging this year in and year out, and show me how that 100% just kept happening. So
listen,
and show me one whole life policy with a mutual company that either of us have ever done business with or talked about. One that's paid the guarantee.
Never.
In the last 100 years,
Never.
And they always paid more.
In the last 100.
So it's insane.
Yeah.
To compare 10% a year. No.
Doesn't.
These things go to zero some years on what you earn.
Not some years. 30 to 40% of the time, they're going to underperform that cost of borrowing 5% that he's talking about. So
I don't know what I just don't. I'm gonna have to go and take a walk. I'm gonna have to go meditate now.
At the end of the day, this is why I created the IUL challenge, right? Is because of this, and because really he inspired it, quite frankly. And the purpose of it was to incentivize.
And Doug, why don't you debate Chris?
Like debate
Chris,
me live
man.
About this.
Debate. Have your own moderator, whatever.
Yeah.
I mean, just get a debate going.
Get the
pull real illustrations into the debate.
Yeah.
Let's have it out, man. Let's look and verify these bold, egregious claims.
Yep.
All right.
Okay.
I guess we're done.
Let's be done.
So look, if you want us to react to other videos, send them on in.
Send a video you want a reaction to, and we'll make it happen. That'll be fun.
All right. Take care.
All right. See you guys.